These are unprecedented times. In a matter of few months, we've gone from all-time highs to 30-40% lower and also retraced halfway back from there. This is a sign of confusion that exists in the minds of investors of all classes, as there is no clarity as to how long will this pandemic last or how deep will a recession be that follows this pandemic. Now, if you step out of this crisis and look back at history, you will observe that each of the past events that led to a sharp correction in equity markets was actually an unprecedented event. For instance, the Great Depression, the Asian financial crisis, the 2001 dot-com boom and bust, and the global financial crisis. Each of these events was new and unforeseen to before. To that extent, therefore, while this crisis is unprecedented, it is not an anomaly, but a feature of the markets. Therefore, we can say with confidence that while we don't know how long will this crisis last or how deep this correction will be, we will eventually get out of this. The history of human civilization has been a story of triumph. Time and again, we've faced numerous hurdles and we've crossed them. Not just crossed these hurdles, but we've looked them as opportunities to find new discoveries and make progress. Therefore, we believe that this is another crisis that we will look back to as an opportunity to invest. That's the long-term outlook. What about the near term, you may ask? Well, we believe that the near term is going to be extremely volatile based on the news flows that will come out over a period of time. History suggests that bear markets are never a single sharp drop in prices. They are usually a series of drops and recoveries all the way up to the bottom. This is what makes them very difficult, as you never get a sense of direction from the markets. The best way to deal with such a scenario, and something that we've been doing in our own portfolios, is to identify a point of weakness in your holdings. By a point of weakness, I mean identify businesses that are either relatively expensive or relatively lower quality based on your overall investment universe. Okay? We've been using the recoveries to sell such businesses. To give you an example, we've been holding for a very long time a very large consumer name that has done relatively well. However, once the correction started, this company did not correct. In fact, when the rally happened in the last couple of weeks, the prices of this company rallied further. We've been using these rallies to pare down our exposure to this company, as we believe that the market is currently offering us similar quality businesses at much better valuations. Therefore, we are trying to use the rallies to create cash, to take advantages of opportunities that we think we'll buy when a further correction comes in. While a correction doesn't come, we sit patiently, we don't utilize the cash. To give you an analogy from cricket, when you're facing a very good spell from your opponent, a guy who's in a very good rhythm, the best thing to do is see him off, not get very aggressive, and look for a seemingly loose delivery and try to put that loose delivery to the boundaries. That's the best way that you can deal with that situation. But how does one identify such loose deliveries, you may ask? How does one differentiate between what is a seemingly loose delivery and what is a very well disguised slower one, the financial equivalent of a value trap? Indeed, when we don't know the extent to which earnings are going to be dented in the near term because of this crisis, it is difficult to judge how cheap stocks are. The best way to deal with this scenario is to think in terms of averages. We tend to get sucked into emotions that surround us. For example, when everyone around us is euphoric, we tend to think that good times will last forever, that this thing will continue, the party will go on. On the other hand, when everyone around us is gloomy, as the scenario is currently, we tend to think that the world is going to come to an end. Reality, however, is never so stark. Reality is always somewhere in between euphoria and gloom. Therefore, the best way to deal with extreme situations is to think about averages. Let me give you an example. We know that the long-term returns from equities is about 10 to 12% for developed markets and about 12 to 15% for emerging markets like India. We also know that over the last 10 years, the returns from equity markets in India have been fairly low, maybe a low single-digit number. Therefore, if long-term averages were to hold, we can be sure that the next decade will deliver much better returns, even better than long-term averages. That is the only way that these averages catch up. This is another reason that we think that crises offer a good opportunity to invest for the long term. And this is why we think that thinking in terms of averages is one of the best ways to deal with valuations during a crisis. While all that is well and good, investing is never free of risk. Therefore, there are two caveats that I want to talk about before we end this discussion. The first is that never think about stocks only in terms of cheapness. Okay? Look at valuations in conjunction with quality of businesses. Seemingly cheap stocks may be cheap for a reason. Maybe there's a problem with the business, maybe there's a problem with the management, maybe the balance sheet is broken. Therefore, every time you look for cheapness, look for good quality stocks that are cheap either to their long-term averages of the past or to their future prospective earnings. The second caveat that I would like to highlight is that stay away from trying to identify the leaders and laggards of the next bull run. Our collective understanding of finding leaders and laggards is flawed. Let me give you an example. In 2001, post the collapse of the Twin Towers, everybody thought that airline industry will suffer the most because people will stop air travel. In fact, for the next 2 decades, travel was one of the most booming industries across the globe. Similarly, post the global financial crisis, people thought that given this is a financial crisis and there are so many liquidity issues, banks and NBFCs, the financial institutions, would face a lot of challenges. Now, we all know that over the last decade, financial institutions were probably one of the best sector to be in. On the other hand, post 2008, most people thought that the way India will recover out of this crisis is by government spending a lot of money, doing a lot of infrastructure spend, and therefore it's best to invest in companies that cater to this segment. However, we all know how that trade played out. Therefore, we think that rather than thinking about winning and losing sectors, it is best to be invested in a portfolio of diversified companies across a number of industries. That, dear investors, is how we are looking at the current crisis and how we are managing the portfolios that we've been running for some time now. To summarize, this is an extraordinary crisis, like all the other crises have been in the past. In hindsight, every crisis has looked like an opportunity to invest, and there is no reason to think that this one is any different. Use volatility to your advantage. Look at price rises as an opportunity to get out of weaker or seemingly expensive businesses. Look at price corrections as an opportunity to buy high quality businesses at cheaper valuations. Don't think of valuations in an absolute sense. Always think of them in conjunction with quality of the business. Lastly, avoid being distracted by trying to identify leaders and laggards. Hold a portfolio diversified across a number of industries. Stay home, stay safe, and keep investing. Thank you.